Hello everyone, this is Dr. Tao's Grunt Lab. In this video, we begin subsection 1.1.1 by discussing the first major investment philosophy, value investing. Before we introduce indicators, technical patterns, or excursion strategies later in this course, it is important to first clarify how different investors think about the market. Value investing represents one of the oldest and the most influential approaches to market participation. And understanding it will help you interpret everything that follows. At a high level, value investing is a long-term approach. The core idea is that a company has an intrinsic value based on its fundamentals, such as earnings, cash flow, balance sheet strength, and dividends, and that the market price may temporarily deviate from this value. When the market price is sufficiently below intrinsic value, a value investor may choose to buy the stock and hold it for an extended period, often years, until the market eventually recognizes the company's true worth. Let me pause here and emphasize something important. Value investing is not about predicting short-term price movements. It is about forming a judgment on the company itself and being patient enough to let that judgment play out over time. Now let's look at one successful example. On the screen, you will see a long-term price chart from NVIDIA. This is a screenshot directly from a trading app. So let me show you this app, and we will go from there. You can use any application you want. Okay, I want to be clear. I'm not showing you a theoretical or idealized example. This is simply a record of what actually happened. This is the annual stock price for NVIDIA. So we can see that, let's just focus on this 10-year period. So if you look at here, okay, it shows that the open price in 2016 is about $0.8. Okay. And the open price in 2026, this year, okay, you can look at here, it is about $190. So the immediate stock price increased by approximately 235 times. And that corresponds to an average annualized return of about 73%, excluding dividends. What makes this value investing example is not just the large price increase. It is the fact that NVIDIA's long-term growth was driven by fundamental developments, strong earning growth, technological leadership, and expanding demand for its products. Of course, it is easy to look at this chart in hindsight and say, okay, I should have bought it, okay, earlier. But in reality, value investing requires making decisions without knowing the future. And this brings us to an important point. Value investing does not always work. Let me show you a contrasting example. So this is the annual stock price for BlackBerry. If an investor believes BlackBerry was undervalued and purchased at any point before 2012, and hold stock for a long run, and the investment would have resulted in a loss. Okay, what makes this example particularly attractive is that BlackBerry was once considered a very strong company. At its peak, it dominated the smartphone market and was often compared with Apple. However, changes in technology increased the competition and shifts in consumer behavior fundamentally altered the industry. Despite appearing undervalued at various points, BlackBerry's business model failed to adapt, and the stock price declined for many years. Okay, you can easily see from this chart. So, let me go back. So this raises a natural and very important question. Can investors manage the uncertainty surrounding a company's future value? My short answer is yes, but only partially. We cannot eliminate uncertainty. No financial model, no spreadsheet, and no analyst report can tell us exactly what will happen in the future. However, we can reduce uncertainty by using a structured process. And one of the most important tools in value investing is the analysis of financial reports. Later in this chapter, I will show you how to locate, read, and interpret financial statements, and how to use them to form a reasonable valuation range. But here is an example conceptual framework. Suppose that based on financial analysis, we estimate that a company's fair value range for next year is from A to B, okay, from $8 to $B. And the current market price is $S. If X is less than A, and the company's fundamentals remain solid, the mean reversion suggests that the price may race towards the center of the valuation range, approximately half of AB. For exceptional strong companies, continued growth and positive market sentiment may even push the price above the upper bound B. The key idea is not that these numbers are precise, but that valuation provides a reference point. It gives us a rational framework for thinking about long-term decisions. And here comes to the fourth strategy. Okay, it's called value investing. This strategy involves buying stocks or assets that are undervalued by the market, based on the belief that economic cycles and mean reversion will eventually lead to market recognition of the intrinsic value. At the same point, I want to give a clear warning. Value investing requires strong judgment about industries, competitive dynamics, and economic cycles. Without careful analysis, investors can fall into what are known as value traps. Assets that appear cheap but continue to decline because the underlying business is deteriorating. This is why value investing is not simply about buying low prices. It is about forming a thoughtful judgment on long-term business quantity and sustainability. All right, that concludes our introduction to value investing. In the next video, we will turn to the second major investment philosophy, price speculation, and contrasted it directly from what we discussed today.